Hello, dear Etorians. This is PC here from Global Alpha Search. We've just finished another month. So here's a monthly update coming your way from me. I will start with showing you a short presentation on how the market and my portfolio performed. I will just share my screen now. Okay, so welcome to the summary of October for 2021 for yeah, my eToro portfolio. The quick portfolio overview just to kick off. First of all, I'd like to notice that I have kind of created a synthetic internal benchmark that will be flexible, meaning that it will be adjusted dependent on the cycle phase. This is mainly for the fact to kind of measure the portfolio's performance against our internal benchmarks. We're still not using external benchmarks because of the characteristics of our investing philosophy. Obviously, you can run through them on my bio and on my pinned post. It's all explained over there. So we have created an internal benchmark at this point of time, which is the recovery phase in the economic cycle, consists of S&P index in 70%, gold, bullion in 15%, and the long-term US Treasuries represented by the TILT ETF, also with a weight of 15%. The S&P was up nicely, almost 6%, 5.7% in October. Gold also added a tiny little bit, but mainly traded sideways this month. And long-term treasuries also added a little bit because the pressure on the yield have dropped a little bit. So synthetic internal benchmark was up 6.8%. And now let's go quickly through my portfolio. The portfolio on the month was up almost 7.6%. So we had a great month after a pretty bad September, when we had corrective markets. We have reallocated quite nicely on some new trades, mainly directional long-term equities, and we have outperformed the internal benchmark quite nicely, and still managed to keep the very low risk. On average for the month it was 3, and maximum was 4. So we do keep the appropriate balance between the risk and reward, which is one of our portfolio's major objectives. 5 holdings right now is the SPXL and EQQQ on the ETF side. That's basically the long equity directional place that I have taken in early October, mainly due to the fact that I saw no downside possibilities on the market, as even with a 5% correction, the market was already trading on very oversold levels. And given the fact that we were entering the fourth quarter, I was expecting the market to rebound. So we did have this final correction that everybody was expecting, and it's done for years. This is my expectation. So we want to be long equities, and we are adding a little bit of beta to the portfolio by the fact that those ETFs are leveraged, right? So approximately 20% of the portfolio is in those long equity directional plays right now. Gold is the second biggest holding right now. It's underweight versus the benchmark of 15% right now. This is mainly because gold has been kind of out of vogue for a couple of months right now, so I keep it underweight and use the cash for investments in some other place, like for instance the long directional equity trade. TILT, we also have it underweight versus the benchmark, currently around 8% versus 15% for bonds as a whole. You need to add to approximately 3% weight in the SHI as well to the TILT to come to an aggregate bond holding. So we are approximately at 11% weight as far as bonds are concerned. versus a 15% benchmark. The pressure on the yields to the upside is still there. So that's the main reason why I'm keeping especially long-term treasuries on the rate for the moment. It might obviously change as the economic conditions change going forward. The biggest exposure right now is Alibaba. We started increasing the exposure as the stock was plummeting in August and September. We have now managed to sold approximately a third of the position with a profit, and I'm keeping the rest as I think there is still very good value in Alibaba right now in the longer term. Current equity allocation is 56% as far as per equity exposure is concerned, and including the ETFs, our equity allocation on aggregate is roughly 79-80% right now. So we are pretty much exposed over the benchmark into equities, which is not 70%, right? But we want to be long more equities than the benchmark into the year end, as I'm still expecting further upside. I will come to that in a second. I have seen a couple of major drivers that led the market to perform as it did in October. Just going through each of them very quickly. Evergrande, it's too early to call a global fallout, right? The situation with the $300 billion debt with Evergrande has for now turned out not to be an issue big enough to derail global markets. I will come to that in a second as well. China regulators are on ease. We have not seen any new rules and laws being implemented to curb big tech in China over the course of October. So this has caused a natural comeback in their equities and a change of sentiment from extreme negative to kind of neutral. We still have higher rates, but the market seems to be getting acquainted with the fact that the rates will be higher. So this is not a big story as it was in the first part of the year anymore. I will explain and show an example of that in a second as well. Tapering, it's coming, but Mr. Powell has managed to kind of lead the market through this situation quite nicely and adjust the investors' expectations. So tapering is not such a big threat anymore. Obviously, once it starts, the liquidity will be smaller. So I'm expecting the market to be not as easy as so far this year, when the buy and long and buy and hold strategy was pretty much the best implement. Inflation higher for longer, mainly due to what's happening with the energy prices and the commodity prices of gas, oil, and coal have been skyrocketing. So inflation will stay here for longer. Still, it did not change the general Fed's attitude, and which is still very accommodative, very dovish, even though they might soon start tapering. So inflation is here, but the monetary policy seems to be accepting that, and the market has kind of learned to accept that as well. Fourth quarter numbers. Fourth quarter is a period which is usually very favorable for equities. I will show you why in a second as well. Strong third quarter 21 reporting season, weaker than the previous ones, but still strong with positive surprises. A short summary on that in a second with you as well. Market cheaper. I will talk you through this as well. Why it got cheaper for 2021, mainly because of improving corporate EPS expectations, and the market having been trading sideways for the period of September mainly. And obviously the correction, the longer-awaited correction everybody was looking for, we finally got it. It was very shallow, only slightly more than 5% for the market, for the major market like the S&P, a bit bigger for Nasdaq and the tech companies. But we finally got it, and everybody that was waiting for the dip had the opportunity to buy it now, where we're entering a good period of the year. So I'm not expecting much more of a correction into the year. And for now, let's move on. So this slide will be for later. So I will just move on to shortly explaining most of those topics here. Evergrande, why is it not such a big deal anymore, and the market are not paying that much attention to it as they did in September or August, right? As you see here in this article from Guardian, Evergrande has already been given a 30-day grace period to make the repayment after missing the initial deadline back in September, and it has since missed other key offshore dollar-denominated bond payments worth another $193 billion. So it's actually defaulted already, and the thing did not really derail markets. So it's kind of a deal done, and the market is just ignoring the Evergrande situation for now, even though it seemed a massive problem at the beginning. The market seems to be ignoring it now, as at least on a global scale. Now it did not manage to derail either the equity markets or first of all the debt markets, right? Now the second topic I wanted to talk through here is basically the markets having gotten acquainted with higher rates dynamics, and I will just show you a graph here that kind of confirms it. The green line is the US 10-year Treasury yield, and the blue line is the Nasdaq performance so far this year. As you see here, in February and March, the sudden increase in the 10-year Treasury yield caused a pretty big rotation and a sell-off in the tech companies. So the market saw it as a new issue and was afraid of it. We then had a similar situation, but smaller scale, at around May, let's say, and it also caused a dip in the tech space. But right now, as you see, an increase in the yields, which we have been experiencing since mid of September, is not really impacting any bigger is not causing any bigger correction in the Nasdaq, right? So investors have basically learned throughout 2021 that the rates will be higher, that the price of money will be higher, and we've learned to live with that adjustment and the rotation out of tech into some more value names from the Dow Jones or the S&P have basically happened at the start of the year and in the middle of the year, and right now the markets have learned to accept higher yields. The third issue is the seasonality. As you know, fourth quarter is usually one of the best seasons of the year. As you see here in the CNBC article, the S&P has averaged outsized gains of 3.9% on average in the fourth quarter historically, and was up 4 out of every 5 years since the World War II, according to CFRA. Next best quarter is the first one, but anyway, the fourth one is usually historically the best quarter ever. So seasonality is on our side, right? That's basically the sum up of all this. Now let's move on to the results. So far, 270 companies out of 500 in the S&P 500 have reported numbers. That's a Bloomberg screen here. And as you see here, the average sales surprise is close to 2%, and the earnings surprise is close to 10% on average for all the securities that have reported so far. Here in the lower left corner, you see the third quarter 2021 compared to the previous quarters. As you see here, the surprises on the sales and earnings have been smaller on average than the last 5 quarters, but still surprises are positive, and I think as long as they are positive, it's a generally positive driver for the market. Biggest surprises were coming naturally from energy, right? With what was happening with the energy prices, earnings surprise on average was a 24% sales surprise, 10% here. The biggest kind of negative surprises were coming from utilities space, where we had a negative sales surprise and a marginally positive earnings surprise only. But on aggregate, the numbers so far for the third quarter are good, and this is a major driver for the market to keep going higher in general. Now, why the market got cheaper, I mentioned earlier for 2021. The fact that the earnings expectations for 2022 are still going higher and the market was going sideways, the PE valuations have actually gotten cheaper. As you see here, at current trailing PE is 26 for the S&P 500, but for the year end of 2021, it's as low as 22. And for next year, which is most important because I think most of the investors start to discount the next year already, it's even lower at slightly above 20 times PE right now. Other pretty interesting things to notice here are the dividend yield, right? The dividend yield is improving. The expected dividend yield on average for the S&P is improving for 2022, and the price to book is basically going lower, right, for similar reasons as above. Average return on assets for next year is 4.8% for the S&P, and the return on equity has been improving over the recent months because of the expected higher earnings. So let's see how we go here. But anyway, for the fourth quarter, the market is looking okay, and into the start of 2021, the market is still looking fairly okay. Now let's take a quick look through the portfolio. Biggest gainers so far are Nvidia and AMD. So the semiconductor space are adding quite good contribution to our portfolio. The TQQQ and the SPXL have also been doing good job in October, as you already saw. That's the long equity directional play that I have put at the start of October, and it's working into the favor of the portfolio quite nicely. Biggest losers, Ubisoft. The stock has been struggling for quite a long time right now, but I think it's trading too cheaply right now to sell it, so I'm keeping this the stock. Besides, it's a relatively small part of the portfolio, 2%. Discovery has been struggling a little bit as well, but also it's very fairly valued, and it stays in the portfolio for now. Alibaba down 11% on the part of the holding we hold, but remember we sold a third of the position with a profit, so I'm fine with holding Alibaba. I see value in this in the long term here, and I'm expecting more upside in Alibaba going forward. Statistical summary of this year so far, we're up 5%. struggled in September, as we have already said, and at the start of the month when we saw the rotation out of big tech companies into value stocks. But all in all, 1, 2, 3, 4, 5, 6, 7 months out of 10 have been either flat or up, which is in line with our objective. 56 profitable weeks as of now, and our average holding time is 6%, will be most possibly getting longer. Now, the last thing I wanted to mention here is basically the inflation, right, which has been and which is going to be one of the biggest drivers going forward. Here on this graph, you see the euro area consumers' inflation expectations, and as you can easily see, they are currently at the highest point in almost 30 years. So this is a clear sign that the expectations of inflation have gone higher over the recent months, and naturally inflation expectations are a natural reason, self-reinforcing reason for inflation to be higher going forward. So what we need to do and what we need to take care of is basically take care of the purchasing power of our money, stay out of cash, and look to be exposed to assets that give inflation protection. And among those assets, I identify 4 major ones. So, of course, real estate, and out of instruments that you can actually trade on public markets would be protected inflation bonds, inflation protected bonds, equities, not all of them, but especially those ones that have pricing power high enough to protect their margins, right? But some cyclicals like the financial space that usually trades better during higher inflation. These are the places to be exposed, and gold as a natural value holder and inflation protection in the long run. I wanted to quickly go to the last slide of the presentation I have showed you at the beginning, with one question to be asked: what's next? Our macro forecasting tool, the enhanced aggregate spread by Dr. Robert Daly, is currently showing who is still in the expansion phase up until December of 2021, but there's a potential phase change at the start of January 2022. So according to the model's indications, at the start of January 2022, the cycle phase might change to boom. Now, it's still not clear whether boom indicators have to do with structural post-COVID changes or are a real boom phase coming. Model is still trying to digest it. There's some more analytical work to be done. Obviously, this cycle and this last recession and this cycle has been much different than any other before. And this one was a structural one. So we cannot really answer yet whether the phase change forecast is going to be real or not, but more work is and will be done into the year end on that. As of now, if at the start of January the model is still showing that we are going into boom, this will naturally mean a lower general equity allocation for our portfolio, as during the boom phase we are usually targeting equity allocation no higher than 40-60%, unless you know the model and Mr. Kelly decide that this is just a structural thing, and we will still be in the expansion phase, and we might stay with higher allocations. But in general, at the start of January, as the things look right now, we should have lower equity allocations in our portfolio. The yield curve, which is still steep and not flattening, does not confirm boom just yet. So this is one of the reasons why the phase change forecast needs to be reconsidered, right? And nor does the Fed approach confirm that the Fed is still extremely accommodative as of now. Now, 2022, despite good corporate earnings projections, and as I have shown you for now, I think 2022 will be tougher than this year. A buy and hold strategy will not be the best one anymore. There will be more, tactical trading needed to be involved. The taper will make liquidity conditions in the market somewhat more challenging, and in general, investors will have to stay more agile than this year. This is my personal view. So that would be it for this month. Thank you very much. We had a good month, and I think we're well prepared to take advantage of the last quarter of 2021 as far as our positioning is concerned. I'll see you in a month, guys. Thank you. Bye.